Okay, the pain is almost over. So we've talked about characteristics of bonds. We've talked about bonds issued at a discount and at a premium. And we've also talked about bonds issued at par or face value. And then we talked about the entries to record bond issuance at a discount and at a premium, and then the amortization of those bonds and premiums. So we've covered a lot of material already. And now the chickens have come home to roost, either because we are going to redeem a bond at the end of the term, which is pretty straightforward. We just whatever if we have $100,000 in bonds, we redeem them for $100,000. But I want to tell you that that's not what normally happens. Okay, let's look at what we have here. It says a corporation may redeem or call bonds. Remember, callable bonds before they mature. This is often done. It's always done when the market rate of interest declines below the contract rate of interest. So if we think about this, interest rates, as I record this anyway, have been on a general downward trend. So this is very, very real. And most bonds are issued for longer than 5 years, 8 years, 10 years, sometimes even more. And so the chances that the interest rate is going to dip at some point during the term of that bond is pretty high. Okay. So when a corporation calls these bonds before maturity, the corporation will issue new bonds at the lower interest rate. Remember, why would you pay out, on a big, massive bond issue, if you're a company, why would you pay out an extra, $600,000-$700,000 every, twice a year if you didn't have to? So callable bonds, and I want to just assure you, most bonds are callable, can be redeemed by the issuing corporation within the period of time and at the price stated in the bond indenture. So if the market rate drops, these bonds are getting called. But there's generally a stated price in the bond indenture that allows the investor to not feel like, well, you kind of just pulled the rug out from under me here, and allows the bondholder to still make a profit just a little bit sooner than what they had anticipated. So inevitably, the amount that's in the contract at which the bond is redeemed is pretty much never going to match up with the carrying amount or book value of the bonds. Okay? So just as if we were going to sell a fixed asset, the amount of the amount that we sell that fixed asset for is probably not going to match perfectly with the carrying amount of that asset. Well, it's the exact same thing with bonds. So notice what it says here. It says a gain or loss may be realized on a bond redemption as follows, and it pretty much always will be recognized on a redemption, at least on callable bonds. It says here a gain is recorded if the price paid for redemption is lower than the carrying amount. Okay, so you owe somebody $20, you pay them $19, and they say we're good, you have a gain of $1. A loss is recorded if the price paid for redemption is above the carrying amount. Okay, you owe somebody $20, you give them 21, well, that was $1 more than you had to pay. We're going to call that a loss. And notice here it says gains and losses on the redemption of bonds are reported in the other income section of the income statement. So this gains and losses on bonds absolutely, positively impact net income or net loss. However, we're not in the business of issuing bonds We just issued bonds to raise capital for operations. Therefore, we're not going to include these gains and losses up in the operating section of our income statement. We're going to put those down below. That way we can see how much money we made or lost from operations, and then we can add these other kind of peripheral items after that to appropriately arrive at net income or net loss. So here we have a situation. We're going to take this in a couple of parts. This is kind of a complicated example. It says, to illustrate, assume that on June the 30th, a corporation has the following bond issue outstanding. Okay, we've seen this example. Face amount of bonds is $100,000. Okay, the premium on the bonds payable is $4,000. Okay. So let's just understand what we've got going on here. Let's bring the calculator over here for just a moment. We have a face amount of $100,000 for these bonds, and we're going to add the unamortized premium to that. And so our carrying amount is $104,000. All right? So let's see what we can do here. Oh no, what are they doing to us? It says, assume that on June the 30th, the corporation redeemed 1/4 of these bonds with a face amount of $25,000. $25,000 is 1/4 of $100,000 of these bonds in the market for $24,000. Okay, good deal. The entry to record the redemption is as follows. Well, what liability did we get rid of? We got rid of a liability of $25,000 on the bonds because we redeemed 1/4 of them. And we also have to debit 1/4. Remember, it was a $4,000 premium, but we only redeemed 1/4. So we also have to debit premium on bonds payable. This totals $26,000. The cash going out is $24,000. Well, $26,000 is not $24,000. So we got rid of a total liability and contra liability. Remember, premiums are added to the amount of the liability on the balance sheet for only $24,000. So we have a gain on redemption of bonds for the difference, which this case is $2,000. So if we had operating income of $100,000 for the year and we didn't have any other items in our other income and expense section of the income statement, we would now have net income of $102,000. $100,000 operating income plus the $2,000 gain on redemption of the bonds. Okay, now we're going to fast forward a little bit. Says, assume that the corporation calls the remaining $75,000 of outstanding bonds, which are held by a private investor, for $79,500 on January the 1st. The entry to record the redemption is as follows. Well, we're getting rid of the remaining bonds payable liability of $75,000, so we have to debit bonds payable. We're also getting rid of the unamortized premium on bonds payable of $3,000. Okay, we add this premium as a contra liability to the actual liability. So we're getting rid of total liabilities and contra liabilities of $78,000. That's what's coming off the books in the liability section of the balance sheet. However, to do that, we had to expend cash in the amount of $79,500. Well, $78,000 is not $79,500. Therefore, we actually have a loss on redemption of bonds in the amount of $1,500. So, just so we're clear, make sure you get this straight in your head. This is something that, for whatever reason, confuses accounting students. Losses, and this doesn't have to do just with bonds. This has to do with any kind of a loss. Losses are treated like expenses, and they are always debits. Gains, which we had here, are basically treated like revenue items, and they are credited. Okay? All right. So just a couple more little house cleaning issues, and we can wrap this up. We already talked about the fact that bonds payable, and there's the key word right there, are reported as liabilities on the balance sheet. Any portion of the bonds that is due within 1 year is reported as a current liability, because bonds are debt financing. So we're going to treat the portion due within 1 year as a current liability. Okay, now the difference between bonds and a note payable is that generally speaking, you know, a bond is either or. It's not both. Okay, so if we have a 10-year bond issue, for the first 9 years, it's a long-term liability, and then for the last year, it is a current liability. But we want to understand that sometimes these large corporations might have 6, 10, 15 different bond issues out there at any one point in time. So the portion of those that are going to mature within 1 year are going to be current liabilities, and then some of those newer bond issues that are going to mature, you know, in excess of 1 year are going to be long-term liabilities. All right, but the bond issue itself is either going to be current or long-term. We don't split up a single bond issue that way, but we might have more than one bond issue outstanding at any given point in time. Okay, we talked about this, so just a little review. Any unamortized premium is reported as an addition to the face amount of the bond payable. That's because we got more cash and we have to balance. Same thing is true for discounts, or the reverse is true. Any unamortized discount is reported as a deduction from the face amount of the bonds. Well, we have to do it that way because we didn't get as much cash as we did the liability. Remember the example, we got $98,000 cash, but the bond payable is $100,000. Well, we have to subtract that discount from the liability so that we balance 98 and 98. Okay? It says a description of the bond should also be reported either on the face of the financial statements or in the accompanying notes. That's not really information that is pertinent that you have. So let's just take a look here at a balance sheet, and let's just see here. Looks like we have all of the usual suspects. We have a current portion of a note payable that we're going to put over here in current liabilities, and that's $200,000, and then the remainder of that note is $1.4 million. But here we have a situation where we have we do have bonds out there, but we only have looks like we have maybe one bond issue is all, and so we have bonds payable $500,000, but these were issued at a discount, and the remaining unamortized discount on these is $16,000. So we reduce that, and we have a net of $484,000. So again, just a liabilities portion of a fictitious company here, so we can kind of see how we do this. All right, that's it for Chapter 11 on bonds. And if you have any questions, let me know.